Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh. We're back on our normal time from Macro Tides. Welcome back,
Here we
Jim.
are.
Here we are, our normal Friday gig. Hey,
Yeah.
interesting week. We had inflation data come out, market, in line with expectations. But you would have thought that we came in almost at a 5 handle on year-over-year CPI because the markets really rallied. So what's up?
Well, first of all, as I've written over the last month, I was looking for the CPI to drop into the sixes based on the takeaway values from December of 2021. And the January, February, and March of this year, we're taking away the values from 2022. Inflation is going to continue to drop more. I mean, I think by the time we get to March, and I've said this numerous times, the CPI is probably going to be down close to 5. So that is what's happening. The big thing, though, Blake, is everyone continues to be focused on inflation, thinking that the Fed is totally keyed on inflation. And I really believe that Powell used his Brookings November 30th speech to pivot away from just inflation to the labor market. And I think that's where we're going to see the, if you will, the collision between what Wall Street wants to believe and what the Fed says it's going to do.
Okay, and that right now their belief is the Fed's going to pivot. We're going to have this soft landing. We're going to have yada yada yada.
Earnings are going to be going up the second half of this year. Couldn't get much better than that.
A lot of optimism.
There is, and a fair amount of conviction. So in the very short term, that I think can sustain markets on this belief that by mid this year, the Fed's going to be cutting rates. They won't have to go as high. And we're not really going to have a recession. May have a slowdown for sure, but it's not going to impact earnings all that meaningfully. So I think the real crunch happens as we get into the second quarter. But in the first quarter, I think earnings are going to come in for the fourth quarter. Okay. I mean, the Atlanta GDP now is 4.1%. Meaning that most industries probably did okay. We've seen energy prices come down. Other costs have also been coming down. Yeah, wages continue to be up. But I think most companies, Blake, are going to report okay numbers, especially relative to the expectations. People are like, oh my God, the numbers are going to be bad. I think we're going to see the economy continue to push forward in the first quarter. Back in mid-22, everyone was talking, oh, we're in a recession. I said, no, we're not. And I think that strength is going to persist into the first quarter. It's the second quarter where the savings runs down more that people have accumulated. The impact from all the rate increases, deliver a bigger punch. And I think that's where the challenge is going to be for Wall Street to maintain this soft landing, everything is rosy scenario.
Well, I'm glad you're here to kick us in the balls. At least it's not going to be for a couple months. So let's talk about financial conditions. What are you seeing here, Jim?
Well, this is the thing. Now, in the minutes that came out from the December meeting last week, they talked about markets, in a sense, reacting with misperceptions. I mean, that's amazing that the Fed's talking that they're misperceiving our messaging. And if you look at where financial conditions, they've retraced everything that we saw since February of last year. So in effect, we're all the way back to where it was in March because Treasury yields have come down, stocks have rallied, the dollar is down, credit spreads have narrowed. So the Fed isn't happy with this because it means that the economy, in effect, is getting some more oxygen from the improvement in financial conditions, which is going to make their job more difficult. So again, I think we're going to continue to hear, and we already have, governors, presidents of the FOMC districts, talking about we're going to 5.1 and we're going to hold it there. Right now, the market is like completely a deaf ear. So the CPI obviously helped. The ISM number, we talked about it last week, it had a big drop. And everyone's, oh my God, look at that. I went and looked at it in the second half of December, from December 23rd on. There was a gigantic storm that impacted more than 220 million people. So that's like more than 60% of the population was either under snow or under wind chill factors. So I think that service number that dropped from 56 to 49 and change, that's going to rebound. I think it was in part. But the point being is everyone wants to choose the data that fits the narrative that, hey, the economy's slowing. That's going to force the Fed not to raise rates as much, and then they'll start cutting them.
So
let's go to the next one. We'll see.
Oh yeah. What do you make for the real funds rate here?
Yeah, well, the CPI came in at 6.5. It's great. It's down from 7.1. The Fed funds rate's at 4 3/8. Oops. You still have the real funds rate is more than 2% negative. Going back to 1970, the Fed has always raised the fund rates until it's above the CPI. So again, if they get up towards 5% by March, in other words, 50 basis points in February, another couple 25s. In other words, some point in time out there in the March, May time window, we're going to see the Fed funds rate, I think, get to a point that it will be above the CPI headline, because the CPI headline is going to continue to come down. But what you can see going back in time, Blake, is historically, it doesn't just get a little bit above the funds rate, where the real funds rate is 0.2. No, it's more like 1%, 1.25. Back in 2004-05, it got up to like 2.5. Obviously, 1980, different environment, really, in some regards. But my only point is, this is what the Fed has always done in the past. And so it just reinforces the notion that they're going to bump the funds rate up closer to 5% because of the historical relationship. The other thing I want to point out, if you go back to, like 2001, look at how much time the funds rate has spent below zero. And that's what Wall Street is used to. Gee, the first sign of anything, they're going to cut rates. But they were able to do that because the inflation rate hung around 2% for most of that window of time. So anyway, this just argues that I think the Fed is going to continue to push rates modestly higher. The key point is they're going to hold it there. They intend to hold it there for all of this year. And that's where the crunch comes in.
And your next chart is where you're dealing with what the market's expectations versus what the Fed's going to do, right?
Absolutely. So I'm sorry, the graph, it's tough to see, but the blue line or green line, depending on how colorblind you are like me, you can see it peaks out at about 487. In other words, where the funds rate is going to be 475 to 5.
Right.
And then the Fed is up between 5 and 5.25. So to me, that they're that off, if the Fed quits at exactly what the street is talking about, 475 to 5. But the main thing is the Fed intends to hold it there. The whole idea is avoiding the mistakes of the 1970s by getting rates up to a modestly restrictive level and then holding it there, as opposed to continuing to ratchet it higher. And I think we're going to see, basically, the 2-year Treasury yield was down to 4.15 yesterday. The Fed funds rate's at 4.37. So historically, the 2-year leads the Fed funds rate. I just think we can't go by the last 20, 30 years of history because of the inflation episode we're kind of working our way out of. So this is what the street believes, and I think they're probably wrong in terms of doubting the Fed's resolve. And there were a couple quotes this week. Powell gave a speech this past Tuesday, and it was about Fed independence and the need to be independent so the Federal Reserve can make tough decisions. But to me, what he said here, but restoring price stability when inflation is high can require measures that are not popular in the short term as we raise rates to slow the economy. In other words, he's anticipating political blowback from obviously Washington as the unemployment rate starts ticking higher. There's going to be a lot of criticism already. Months ago, Elizabeth Warren, Maxine Waters, what are you doing? You're going to toss millions of people out of work. But the Fed really believes that they need to do this to bring inflation down, that a stable, as he says, price stability is the bedrock of a healthy economy. He's repeated that line many times in the last 6 months. This is what they believe. And the other thing, Kashkari, remember, he used to be a big dove. Now he's pretty hawkish. He's one of the guys at 5.4% on the funds rate. And I saw an interview recently where he, and my suspicion was he's in line with Powell because he's bought into the idea that high inflation hurts those at the bottom of the income spectrum more than anybody else. So who's going to benefit most from stable, low inflation? lower income people. And that's been one of his focuses. But his comment, I spend enough time on Wall Street to know they are culturally, institutionally optimistic. They are going to lose the game of chicken, I can tell you that. So that's how he was phrasing this in December, that Wall Street's got this narrative that we're going to do such and such, and that's not what we're going to do. So to me, all of these comments and statements reinforce all we're hearing with the speeches from just about every single person on the FOMC.
And one of the things that you do hear, Jim, every week, well, not every week, because obviously we don't get comments like this every week, but when we do meet here, and you do emphasize that we do, as traders and as investors, we need to pay attention to what the Fed is saying and what is the message they're delivering. And this is very clear. Don't bet against us. Like, we're going to keep rates high. So,
well, this goes with the theme that we've talked about for many months, that when you have a 40-year high in inflation, you need a completely different monetary policy, and it's one that no one has experienced in the last 25, 30 years.
Sure.
And the Fed did shoot themselves in the foot, saying inflation was transitory. So people just think that they're going to be wrong. And Jeff Gundlach, who I respect, I like to hear his opinion. He basically said, the market listen to the market. They got it right. And I'd say 90% of the time, under normal circumstances, that's probably good advice. I just think we're in a unique time period where the Fed feels compelled to hang in there longer. And as I've said, I think there's a window of time where we're going to see more definitive signs that the economy is slowing meaningfully. I think they show up in the second quarter, and the Fed is not going to budge. And that's where I think the stock market could be most vulnerable to a pretty good decline.
Well, okay, before we talk about the stock market, let's talk about the dollar. So
why not do that?
Yeah.
So, the perception in the stock market is not just confined to the stock market. I think it's in all the markets. The idea that, okay, the Fed is going to have to, stop raising rates, lowering them not that far in the distant future. And I think it's impacted things like the dollar, of course. Other things have helped the euro strengthen. Warm weather, the energy prices being much lower than anybody anticipated. But to me, the pattern of the dollar suggests it's near a trading low, a decent trading low. You got 5 down. It's coming down to a trend line that goes back to the lows in January of 2021. And sentiment is pretty negative on the dollar. And I think what it implies is, at a minimum, a rally back to 106 to 108-ish. Those are kind of like wave 4 of lesser degrees, So again, I think if I'm right, as the Fed continues to push that, folks, you got it wrong, that at some point in time probably gives the dollar at least somewhat of a rebound and lift, along with some short covering.
All right.
Or long liquidation for those who are long other, currencies.
Let me go ahead and, sorry, I brought up the wrong thing. Let's talk about gold.
Gold. Okay. So, gold has run more than I expected, and just full disclosure, right? I thought 1770 or so and above was a great place to, after being, positive at 1630. Gold has spiked. But if I'm right about the dollar, I think that puts a lid. Gold is coming up to some fairly significant resistance up around that 1900 to 1920 level. It's way overbought. So I just think gold is setting up for a retracement of some magnitude. And at a minimum, my guess is 1780 to 1820 isn't that bad. I didn't calculate what the 382, but effectively ran from what? It's $300, $120 from 1920. Yeah, get you right around 1800, give or take. And then we'll just see what kind of a pullback. It's possible that the bottom back in October is a really, really important bottom, that the correction from August of 2020, when gold topped at 2070, all along I'm like, hey, I think we're going to complete this correction, ABC down. It very well may have finished. And that this rally is wave 1 of a new advancing wave that'll take gold comfortably above 2100. All right.
Wow. That'd be something.
You're still going to get a wave 2 pullback.
At some point. Right.
So
right.
I think we're close to that. Anyway.
Okay. Well, that's interesting. And I think a lot of gold bulls probably would agree with you on that one. So what does that mean for the stock market?
Okay. So we're up, the bottom panel is a 21-day net advances minus declines. It's an oscillator. It shows you what's happening internally with the market's breadth. When it gets really oversold, it's typically a time to start looking for rallies that you can see off these September, October lows. You get divergences. It's a nice setup. It's really overbought. People are really buying into this idea that we've got a soft landing almost guaranteed. So what this tells me is that when you get this overbought, like you get a pullback, that first pullback is usually bought. So you get another bounce, and then you get a deeper pullback before you can really resume the advance. That's what I expect, some choppiness with a pullback in the S&P. 3850 would not be that unreasonable. And then I think if everything holds together, a move above 4100 that gets the S&P up towards 4250. And then I think reality sets in. In other words, the Fed meets on February 1st. In all likelihood, they're going to go 25 basis points. Guys like Bullard would probably be more inclined to go 50. They'll start telling us maybe in the next week or so, because there was a 10-day blackout, so they only have about another week left before they have to stop doing speeches. I think the market wants to rally up into that Fed meeting, so it gets a pullback and then push up into that meeting.
That makes a lot of sense. So now you got this chart on Treasuries.
Yep.
What does that mean for yields here?
I think yields are going to tick higher. The 50% retracement, you look at the bottom left, you can see 252 on the 10-year rallied up to 433. The 50% retracement was 43429, which is where I have that red horizontal line. We've tested it in December a couple times. We're there now. My expectation is that yields are going to tick up potentially. That the decline from 433 to 340 is the first part of a larger decline in yields. The tick up to 390 is wave A. The tick down to where we are today is B, and that the yields could tick up towards 390 before we would have another meaningful decline in yields. Again, predicated in part that I think as we get into the second quarter, the economy is going to show much more signs of slowing.
Okay, and as that happens, you expect yields to eventually break down.
I do.
Okay. All right.
In other words, they'll break below that 340. But here,
okay.
To me, this is not the place to be long Treasuries. I think we're going to see a tick higher. And then, if indeed we get up near 390 and everything, technically looks okay, then it's like, okay, now you got another good entry to go long on Treasuries.
That makes a lot of sense. Well, Jim, thanks for speaking of making sense. Thanks for making the markets make sense for us each and every week here on Trader Summit. And remember, if you have any comments for Jim, I'll jump down in the comments below. And if you have anything that you'd want to add to his analysis or any thoughts or ideas about what he had to say. But Jim, what's the best way for us to follow your work? Because I love what you do at Macro Tides.
Thank you, Blake. Macrotides.com. And if you want some information, recent reports and so forth, shoot me an email, jimwelshmacro@gmail.com. I'm always happy to send them out to faithful listeners of Trader Summit.
Yeah, tell them that Blake sent you. How about that?
That sounds cool.
All right. Well, Jim, I want to thank you for spending all your time with us each and every week. Yeah. And then we're going to catch you next Friday once again. And have a great weekend.
You do the same. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.